A licensed life agent is the only person who can work with an investor to prepare and submit a segregated fund application. The application is a step toward owning the investment, which is preceded by the agent's recommendation in the reason why letter and followed by the financial contribution to the contract. The completed contract is a legal document that serves as evidence of the agreement between the insurer and the investor, binding both parties to the terms of the investment. Individual Variable Insurance Contract, IVIC. An individual variable insurance contract, IVIC, is the type of legal document used for a segregated fund contract between an insurer and an investor. The IVIC outlines the conditions for purchasing, terminating, and withdrawing from the segregated fund, as well as for receiving benefits from it. It is a disclosure document designed to inform the investor about the product they are buying and to emphasize the risks involved. The contract outlines the insurer's commitments to the investor, including guarantees and benefits, the method for determining the value of benefits based on the fund's market value and surrender value, the percentage of the premium allocated to providing benefits, when the fund's value and benefits are determined, fees and charges, including how they are calculated, the right to make changes to the contract. The contract also specifies what information is part of the agreement, such as identification of the IVIC and the segregated fund, the management expense ratio, MER, risk disclosure, fees and expenses, the right to cancel, a statement confirming the accuracy of the fund facts information and the remedy for any errors. An investor has the right to rescind the contract by providing a written request to the insurance company within 2 business days after receiving confirmation of the purchase. If rescinded, the contract owner will receive the lesser of the amount invested or the fund's value on the valuation day following the insurer's receipt of the rescission request. Any fees or charges are also refunded. The contract owner is considered to have received a confirmation 5 business days after it has been mailed by the insurer. All segregated fund contracts must provide this information, ensuring investors have the same contractual rights regardless of the insurer they choose. The contract can be attached to the application form or provided to the investor after the insurer receives the application. A sample contract does not constitute a purchase. The purchase is confirmed by the contract's effective date. The effective date is the valuation date after the first deposit is received and all contract criteria have been met. A unique reference number is assigned to the contract and is used for all communications between the owner and the insurer. Investor requirements: the investor must provide accurate and truthful information to help the agent complete the application form. The investor should make decisions that are suitable for their needs and objectives, either based on the agent's recommendations or their own independent judgment. The agent assumes the investor understands their decisions and their consequences. If the agent is unsure of the client's comprehension, they should consult a direct supervisor before proceeding. The second requirement for the investor is to fund the account. Application form. The application form is completed jointly by the investor and the agent, and may be done virtually. The investor provides the necessary information, and the agent records it on the form. The form is typically multiple pages long, and the agent may need to explain certain parts to ensure the investor fully understands their options and commitments. If the investor does not speak a language the agent understands, the application should not be completed until a translator or additional information can be provided to ensure understanding. The investor must review and correct any inaccuracies on the form. The investor and the annuitant, if they are different people, must sign and date the application to confirm their agreement with the information. An exception to the signing requirement is made when a power of attorney (POA) for property is in place due to the client being ill, mentally incapacitated, or absent from the country. The individual with POA can complete and sign the application, but a legal opinion may be needed regarding their right to name a beneficiary. The agent must carefully record information on the application since it forms the basis of the contract. An incomplete application will be rejected by the insurer. Reason why letter. The reason why letter is prepared at the time of the application. It is a critical part of insurance sales suitability, as it proves the agent has addressed the client's needs by making recommendations and documenting whether the client accepted or refused them. The letter confirms facts and verifies client instructions, identifies the client's needs met by the product and those that remain uninsured, documents that the sale is suitable, substantiates the client's understanding of their purchase. The reason why letter is not optional. The agent must prepare it, review it with the client, and both parties must keep a copy. Registered or non-registered form. A segregated fund account can be non-registered or registered, with registered accounts further categorized as locked-in or non-locked-in. While certain locked-in accounts may have age restrictions, non-registered accounts do not. It is crucial to select the correct account type, as an investor could be financially disadvantaged if a registered account is incorrectly set up as non-registered. To open a registered account, the contract owner must provide their social insurance number, SIN, for tax purposes. In a registered contract, the owner and the annuitant must be the same person. Ownership cannot be transferred, and the contract cannot be used as collateral. In contrast, a non-registered account may have an annuitant who is not the contract owner. The owner can be an individual, a group, or a corporation. Non-registered accounts can be purchased until the annuitant turns 90. Benefits of a non-registered account include: ownership can be transferred according to the insurer's rules. It can be used as collateral for a loan by assigning the contract to the lender. Naming annuitant and beneficiary. The contract owner holds the rights of ownership, such as the ability to assign the contract, and names the annuitant and beneficiary. The annuitant is the person whose life the guarantees are based on and whose death triggers the payment of the death benefit. Once named, the annuitant cannot be changed. However, in a non-registered contract, a joint annuitant can be named before the death of the initial annuitant to replace them if they die. The contract then continues until the death of the last surviving annuitant, at which time the death benefit is paid out. The beneficiary receives the contract's benefit after the last surviving annuitant dies. More than one beneficiary can be named, but a percentage of the death benefit must be allocated to each. In a spousal RRSP, the recipient of the deposits is both the owner and annuitant, and they name the beneficiary. The person who made the deposits does not have ownership rights. After the contract owner's death, the insurer may release information to the beneficiary and the owner's estate. Rider election form. A rider election form is provided to contract owners who invest in Guaranteed Minimum Withdrawal Benefits, GMWB. This form specifies that the GMWB is being elected, provides payment options, lifetime or to an end date, and offers space to fill in the correct fund codes that offer the rider. It also describes minimum initial deposit requirements, gives a choice for payments, and instructs on payment frequency and method. The form requires mandatory authorization by both the owner and the agent. The rider addresses the impact of excess withdrawals, which can significantly reduce the contract's value and may result in the owner not receiving their expected future payments. Client identification requirements. The Financial Transactions and Reports Analysis Centre of Canada FINTRAC was established under the Proceeds of Crime, Money Laundering, and Terrorist Financing Act, PCMLTFA. As Canada's financial intelligence unit, FINTRAC helps to detect, prevent, and deter money laundering and terrorist financing activities. Under the PCMLTFA, agents are obligated to properly identify clients and keep records if the client is expected to deposit $10,000 or more over the contract's lifetime, or if a beneficiary will receive $10,000 or more from an annuity or policy. The agent must also determine if the client is acting on behalf of a third party and, in specified circumstances, submit a terrorist property report to FINTRAC. These requirements do not apply to registered accounts. Requirements also exist for agents when a large cash transaction is made. A large cash transaction is a single cash deposit of $10,000 or more, or multiple cash deposits totaling $10,000 or more within a 24-hour period. The term cash refers to notes and coins, not checks, transfers, or bank drafts. When an account is opened, reviewed, or a suspicious fact is detected, the agent must confirm if the client is a politically exposed foreign person, PEFP, a domestic politically exposed person, PEP, a head of an international organization, HIO, or a family member or close associate of one of these individuals. A PEP is a person who has held a government or judicial position in a foreign country. A domestic PEP is a person who holds or has held a specific office or position in the Canadian federal, provincial, or municipal government within the last 5 years. An HIO is the head or CEO of an international organization created by the governments of multiple countries. If a client is identified as high risk, specific obligations apply to record keeping, establishing the source of funds, and obtaining senior management approval to maintain the account. FINTRAC provides 3 methods for suitable client identification. Photo identification. For individuals who are physically present, the ID must be a valid, current, and authentic government-issued document, federal, provincial, or territorial, with a unique identifying number, and the name and photograph must match the individual. Foreign-issued photo IDs are acceptable if they are equivalent to Canadian ones. Examples include a Canadian passport, permanent resident card, or U.S. passport. Credit file. The file must have existed for at least 3 years, and the name, address, and date of birth must match the information provided by the individual. Providers include Equifax Canada and TransUnion Canada. Dual process. 2 original, valid, and current documents or pieces of information from independent and reliable sources must be provided. The name, address, and date of birth on both sources must match. One source can verify the individual's name and address, e.g., Canadian passport, while the second verifies their name and date of birth, e.g., birth certificate. Alternatively, one source can verify name and address, and the second can verify name and confirm a financial account, e.g., credit card statement. Ontario, Manitoba, Nova Scotia, and Prince Edward Island prohibit the use of their provincial health cards for identification. Corporations and other entities must also provide acceptable identification, such as a certificate of corporate status and the names of directors. The agent must be fully confident that the person in the identification papers is the same person making the application. If the agent suspects the applicant is acting for a third party determination form must be completed. Any suspicious transaction or attempted transaction may be of interest to FINTRAC. Suspicion is a combination of facts, context, and money laundering indicators. There are 3 thresholds for suspicion. Simple suspicion. A hunch or gut feeling that money laundering or terrorist financing is occurring. Reasonable grounds to suspect. A probability that money laundering or terrorist financing is happening. Reasonable grounds to believe. Support for the probability that money laundering or terrorist financing is occurring. Any attempted or completed suspicious transaction must be reported to FINTRAC, though the agent may first choose to discuss the situation with a supervisor. All financial services. Professionals have a responsibility to follow FINTRAC guidelines to help curtail and eliminate money laundering and terrorist financing. Funding the account. A deposit must accompany the application. It can be a lump sum check made out to the insurer, a transfer, or by providing the date for the first pre-authorized deposit pad. Pads specify the frequency, e.g., weekly, monthly, the date of the first withdrawal and subsequent withdrawal dates. Banking information, including a void check or a stamped confirmation from the bank, is required for pads. The deposit is allocated to the selected funds, and the contract owner specifies either the dollar amount or percentage to be applied to each fund. In some jurisdictions, spousal consent or a written waiver form may be required when transferring locked-in funds. An RRSP locked-in retirement account (LIRA), also called a locked-in retirement savings plan (LRSP), can accept deposits until the end of the year the owner turns 71. To continue tax deferral, an RRSP can be converted to a registered retirement income fund (RRIF), and a LIRA/LRSP to a life income fund (LIF) or life retirement income fund (LRIF), or a prescribed registered retirement income fund (PRIF) for Saskatchewan and Manitoba. The insurer handles these transfers, setting up the contract owner in the proper new account with the same fund and unit value as before the conversion. The investor is informed of the unit value for each deposit, which serves as a benchmark for future performance monitoring. Agent requirements. Agents must meet the expectations of both the client and the insurer they represent regarding pre-sale activities, application completion, document delivery, and post-sale service. Meeting carrier expectations. The agent is expected to meet the carrier's standards for business volume, client contact, accuracy in dealings, and necessary record keeping. Document delivery. For a purchase to be completed and a contract issued, it must be delivered to the investor in person or via registered mail. The delivery package includes the contract, an information folder, fund facts, and a contract confirmation. If a delivery receipt is included, it must be completed, signed, and witnessed before being returned to the insurer. Other forms, such as a change of beneficiary form or a death claim form, may be required later if the client's situation changes. Information folder. The information folder describes the features of segregated funds and how they operate. Its purpose is to provide a brief, plain-language disclosure of all material facts about the IVICs offered by the insurer. Typically, one information folder is issued by an insurer for all its funds. A summary of key facts may be included as an overview of the details provided within the folder. Fund facts. Fund facts provide specific details for each fund offered by the insurer. One document is prepared for each fund as of December 31st of the preceding year. The information is presented consistently across all funds to facilitate comparisons. Agents must review the fund facts for the recommended funds with the investor to ensure they understand the recommendation and to answer any questions. Confirmation. A confirmation is required to finalize a purchase, switch funds, reset, withdraw money, or terminate a contract. It can be provided to the investor electronically or in writing. Verbal instructions from a client can also be binding. Ongoing service requirements. The sale of a segregated fund contract does not end with the confirmation of purchase. A good agent provides exemplary customer service after the sale. Post-sale follow-up. After the sales process is complete, an agent should follow up with the client to ensure they are satisfied and to answer any new questions. Maintaining open communication reinforces the agent's value and can lead to additional business or recommendations. Need to monitor client. The agent must inform the client that they need to report any changes to their personal situation that could affect the contract, such as a change in beneficiary. The agent should also periodically check that client information, such as their address, is up to date. It is also important to know if a power of attorney, POA, has been invoked, as the client would no longer be able to provide directions for the contract. Need to monitor product. Agents must stay informed about new segregated funds, as well as changes to existing ones, such as a change in portfolio manager or MER, which can directly affect performance. Significant changes to a fund are usually communicated by the insurer, but the agent may want to reinforce the impact of these changes to the client. If a fund experiences a substantial loss in value, the client must be informed. Providing this information, even if it is bad news, shows that the agent is monitoring the fund and can address the client's questions and concerns. Annual review. At a minimum, the agent should meet with the client annually, either in person or virtually, to review the investment and its performance. During this review, the agent should be prepared to discuss the returns since the last review and the reasons behind the performance. This is also an opportunity to check for any changes in the client's personal situation and to ensure they are aware of any significant changes to the fund. Handling deposits. When a check accompanies an application, it must be handled securely and sent to the insurer immediately. There is no room for error when handling money and banking information. The check should include the contract number to which the payment is to be applied. Making a fund switch. A fund switch is a change from one fund to another. It can be either unscheduled or scheduled. An unscheduled switch is made by request to the agent or insurer, often due to a desire to rebalance the account or dissatisfaction with a fund's performance. The request can be made at any time, but a minimum amount is required for the switch and the fund must meet its minimum balance. Most insurers offer a number of free switches per year, and a withdrawal fee may be charged for switches that exceed this limit. Some switches may not be allowed depending on the sales charge or contract guarantees. A switch can also act as a reset, changing the contract's maturity date and guarantees. A short-term trading fee, e.g., 2%, may be charged or the switch may not be permitted if units are switched within 90 days of purchase. Information about this fee is in the fund facts. A scheduled switch is set up on a regular basis, usually monthly or quarterly, and does not require a request from the client. Fees are not charged for scheduled switches, but the insurer can cancel or redirect them, in which case the investor will be notified and given options. A switch can result in a capital gain or loss if the amount switched exceeds or is lower than the adjusted cost base of the units. Resets. A reset allows the contract to be reset to a higher account value based on market value, and can be either scheduled or unscheduled. Not all funds allow resets. When a reset is completed on a 10-year contract, the new maturity date will be 10 years from the reset date. Some insurers limit the age at which an investor or annuitant can make a reset, for instance, to age 80. An unscheduled reset is used by an investor to lock in a gain when the value of their units has increased. The contract owner informs the agent or insurer of their wish to reset, and the request is processed. The number of unscheduled resets per year may be limited by the insurer, so an investor could miss a market high if they have used their allotment. A scheduled or automatic reset may be restricted to a schedule set by the insurer, such as twice per year. Instructions from the contract owner are not required. The reset is only performed if the market value is higher than the unit's deposit value. Change of beneficiary. The beneficiary is specified on the application, but may need to be changed if, for example, the beneficiary dies or the contract owner wishes to designate a new one. This can be done at any time by the contract owner, as long as the beneficiary designation is not irrevocable. A revocable beneficiary can be changed at any time with a written request to the insurer or by completing a change of beneficiary form. An irrevocable beneficiary can also be changed, but only with the beneficiary's consent. The insurer must be notified of the change in writing, and the change becomes effective on the date of signing. Renewing a contract. At the 10-year maturity of a contract, its value can be taken as cash or in the form of an annuity, or it can be renewed for another period. When renewed, a new guarantee period begins, and the new maturity date depends on the annuitant's age at the time of renewal. The initial contribution to the renewed contract is the total market value or the guarantee if the market value is lower. The death benefit guarantee continues. The agent is involved in recommending the renewal and ensuring the proper documentation is prepared and submitted to the insurer in a timely manner. Claims. A claim for the value of a contract can be made by the contract owner for withdrawal, surrender, and maturity, a beneficiary or estate trustee at death, The person in control of the contract when a POA for property is invoked, for withdrawal, surrender, and maturity. The claim results in the payment of the contract's value or a specified sum, minus any outstanding charges or fees. An agent should not attempt to calculate the amount to be paid, as they may be unaware of all enhancements or charges. Claims process. The claims process does not have to involve the agent, as forms can be ordered directly from the insurer. However, an agent may choose to be involved to provide customer service to their client. Claim forms. Both withdrawal and death benefit claim forms can be ordered directly from the insurer. They must be returned completed, signed, and with any attachments or information the insurer specifies. Once submitted, an insurance representative specializing in claims handles the process of issuing a check, checks, or transferring funds. Types of claims. Tact and sensitivity are required when an agent is involved in a death claim. Other types of claims are simply financial transactions that require professionalism, efficiency, and privacy. Maturity claims and death claims. A maturity guarantee is claimed by the contract owner or their POA when the contract has matured. A death benefit guarantee is paid to the beneficiary upon the death of the annuitant. Both guarantee amounts are a contractually obligated percentage of deposits, adjusted upwards by any resets and downwards by any withdrawals. If the market value is not equal to the guarantee, the insurer will contribute the difference. The declaration of death is made by the beneficiary or estate trustee. The claim must include the contract number, the claimant's signature, the agent's name and number, and proof of death, an original death certificate or attending physician statement. Additional documents may be required, especially if the death occurred outside the country. Termination and surrender claims. Termination occurs at contract maturity, while surrender happens before maturity. Both are considered claims that terminate the contract. A contract can be terminated at any time by completing a withdrawal form, provided it has not matured and annuity payments have not started. Upon termination, the owner can choose to receive cash, buy an annuity, or select another option provided by the insurer. Locked-in accounts may have restrictions on receiving cash, and their value may need to be transferred to another locked-in account depending on the applicable provincial legislation. Withdrawal form. A withdrawal request is initiated by the contract owner. The withdrawal form is used for both closing the account entirely and for making a partial withdrawal. Charges may apply, and the client must specify if the amount requested is net of charges, the actual sum they will receive, or gross. The form requires contract owner information, identification of the contract type, selection of withdrawal options, selection of payment form, e.g., check, direct deposit, transfer. Instructions for setting up a scheduled withdrawal plan, SWP. Selection of the fund number from which the withdrawal will be made. The specified amount to be withdrawn. The signature of the contract owner and any irrevocable beneficiary. The agent's signature, date, and time. Withdrawal options cover many circumstances beyond a simple partial or full withdrawal. The contract owner can also use the form to set up or change a scheduled payment plan, change the amount, date, or allocation of scheduled payments, change banking information for scheduled payments, stop scheduled payments. A minimum annual withdrawal is required for RRIF contracts. For LIFs and restricted life income funds, RRIFs, withdrawals must be between the annual minimum and maximum limits. Power of attorney POA claim. A POA for property document appoints another person to act as a substitute decision-maker for the contract owner's property if they become unable to do so. The person with POA controls the contract, potentially with the exception of naming beneficiaries. Instructions for withdrawals or surrender from the person with POA must be respected. If an agent suspects the person with POA is not acting in the contract owner's best interests, they should discuss it with their manager or supervisor. Factors affecting claims. The amount received in a claim may not be what the contract owner expected. They must fully understand the effect of withdrawals, sales charges, guarantees, and allocations. Maturity and death benefit guarantee. The amount received at maturity or death can exceed the guaranteed amount if the contract's market value is higher. However, if withdrawals are made, the guarantees are adjusted downwards in proportion to the account balance. The timing of the maturity guarantee can also be affected by a reset. Allocations. When a segregated fund generates income from interest, dividends, or capital gains, that income remains in the fund and is reflected in its unit value. This investment income and any capital gains or losses are allocated to investors annually. This allocation increases or decreases the adjusted cost base, ACB, of a non-registered investment, ensuring that this income is not taxed again upon withdrawal.